How are you?
Pleasure.
Good afternoon, I'm Don. Nice to meet you. There's a butter sheet for you.
Thank you.
Good afternoon, I'm Don. There's a butter sheet for you.
Thank you very much. So go ahead and just take a minute to make sure all your things work and that extra breath before you start them.
Yep, there we go.
Nice up. Good afternoon, Garcia family. We're from North Lake Financial Agency. We're going to be your financial planners helping you throughout this process. So Miguel and Sophia, using the information that you have provided us with, we've broken it down into 4 priorities that we think are most important to your family. The first, establishing an organized budget to make sure we know where all of your money is being spent each month. Next, transportation. We know Elena will be driving soon, so that will need some changes in your current family's vehicle situation. As well as investment, meaning looking into the future of Miguel and Sophia for your retirement and your children's college funds. And with Rosa moving into your home, some renovations will be needed. So we have laid out your current budget, your monthly budget into excess income, your monthly expenses, and your total debt. And if you guys need to reference any information, the budget sheet in front of you is where you find those answers. So currently, you're spending about $8,000 per month with $40,000 in debt. And with our recommendations, we can increase your monthly excess income by nearly $3,000 and completely wipe out your debt. So with Rosa moving in, she has $150,000 left over from her home sale, and currently out-of-home care costs about $10,000 per month. So we do not think it's unreasonable to assume that she's contributing some of this money to help out the family. So immediately using that money, $10,000 of it will be going towards renovations to make sure everyone's comfortable in the new living situation. And with the remainder of that money, it will be used to cover your debt, set up an emergency fund, a health savings account for Rosa to make sure any unannounced medical costs are taken care of, and your children's college plan. And a portion of this money will be given back to Rosa to make sure she still has freedom to do all of the activities she would like to do. So Miguel and Sophia, I know there was some debate on whether you should move homes or renovate your current one to account for the new living situation. And currently you have 12 years left on a 4.25% interest rate loan for your home. And right now the current market average for home loans is at a 6% interest rate, so it's not gonna be worth it to take out that new loan to buy a house. So we're gonna recommend you renovate your basement to add a bedroom, which will allow both of your children and Rosa to be living comfortably in their own rooms. And that's gonna cost about $10,000. So now Marae is going to speak on our suggestions and our recommendations with that.
Yep, so we have just a few recommendations to help cut down on some excess monthly spending. Starting with those subscriptions, we recommend that you keep the Netflix and Peacock accounts, but switch to using free Spotify services, and in a similar way, cut down that Lifetime Fitness membership to a $60 per month one at Planet Fitness instead. In terms of those buy now, pay later services, we really do understand the convenience of those, but it's quite easy to accrue a bit of debt if we're not making those payments on time, so we suggest that you cut back on those services. And a question arose about whether you should keep your finances separate or joint. We recommend a hybrid of the both, keeping a joint account for all utilities and everything related to savings, but also having those individual accounts so you can make those personal purchases over the course of the month. Sophia, in terms of your employment, we recommend that you keep the home bakery for now. You're making more money than if you were to work externally, and it also provides a greater flexibility in schedules as Rosa may need increasing medical care. Just touching on the individual spending a bit more, we really do want to keep that to a minimum, allowing around $50 for each per month, and that can roll over and save for larger purchases over the course of the year. Something you mentioned as being really important to your family were those Lions tickets, and it's well within your budget with that house sale money to go ahead and make that purchase. Right now, the cost of the Traeger does not make that purchase currently feasible, so that's something that can be saved for and bought down the line. We really wanted to touch on those restaurant habits, and we advise switching to a bi-weekly eating out plan, cooking at home for the rest of that time. Miguel, if those lattes are the only thing keeping you going at work, keep with that practice, but just know that packing lunches can be a great way to cut some of those costs. I'm going to cover paying off debt. What we really want to get into is those credit cards. They have quite high interest rates. So we're going to suggest that you use your tax refund from this year to cut the majority of that debt. We're going to come back to that tax refund in just a little bit, as there tends to be some misconceptions around that. But once we cut the majority of that debt, we want to cover what's left with the money left over from the house sale. We also recommend switching the both of you to a Chase Freedom card. It has no fees and cash rewards, and it stands as a better alternative to what you guys have currently. In terms of the vehicle plan, Miguel, we recommend that you pass down that Ford F-150. There may need to be some repairs, but the cost of that will certainly be less than a new auto payment. We understand that Rosa is less able to drive as she was previously, so we advise trading in that Ford Explorer for its current value to get rid of once your lease ends, we can purchase 2 used vehicles for you and Miguel, which we have looked into, and we recommend this 2018 Jeep Grand Cherokee for around $10,000 for you, Sophia, and for a similar price, the 2020 Ford Edge for Miguel, both great family vehicles, and again, keeping that Ford F-150 for Elena before she moves to college.
Thank you, Maria. Now Lissa's gonna speak on your insurance policies and taxes and our recommendations in that field. Lissa?
Okay, so you guys mentioned that you had a $4,000 tax refund this year, and I just want to clear up a little bit of a misconception about that. It can feel like free money because you just got that payment this year, but you actually overpaid on your taxes last year, and so you essentially gave the government an interest-free loan on that money. We recommend in the future that you increase your deductions on your W-4 form from your employer in order to keep that money, and you can invest it and gain interest. As we mentioned previously, we also recommend opening up a high-yield savings account to be used as an emergency fund. This money can be used to cover 3 months of costs, as well as some of Rose's healthcare if necessary. We recommend initially contributing $20,000 from that home sale, followed by $250 per month. We know you were a bit concerned about your auto insurance increasing when Elena started driving, so we were able to find you a plan for only about $90 more than your current plan. We were able to offset the cost of the additional car and the additional driver by raising your deductibles to $500, which does lower that premium. We also recommend that you raise the underinsured and uninsured motorist coverage to equal your liability coverage because Michigan is a no-fault state. For your health insurance, Miguel, your employer currently sponsors a healthcare plan for you and your family. We recommend keeping that plan, but for Rose's medical care, we recommend that she enrolls in Original Medicare, Medigap, and Medicare Part D, which will give her a predictable monthly cost, as well as covering a lot of additional surprise expenses. For the health savings account, we also recommend that you open that up. That money is never forfeited, and it has a triple tax advantage, so you can accrue interest over time. We recommend initially contributing $10,000 from the home sale and $480 per month after that, and this can be used for any of those additional costs for Rosa. For your life insurance, Miguel, you currently have a whole life insurance policy through your employer. We recommend surrendering that policy to purchase a term insurance policy for yourself and for Sophia, which will give you $1 million of coverage between the two of you that covers any outstanding debts as well as any college costs for your children. For Rosa, any additional end-of-life care that would be covered by that policy isn't worth the additional monthly costs, so we don't recommend enrolling her in life insurance at this time. Finally, Miguel, you currently have short and long-term disability through your employer. We recommend that you keep that because around 80% of people will need that at some point in their life. And we also recommend that Sophia, you look into disability insurance. We were able to find you an inexpensive plan that'll give you $1,000 of coverage should anything happen and you're unable to work.
Thank you, Lissa. Now Ben's gonna speak on Miguel and Sophia looking into the future for your retirement and your children's college fund. Ben?
Miguel and Sophia, you guys had mentioned that saving for college and saving for retirement was a goal of yours. So we found a way to allocate your current excess income of $4,029 as a way to meet some of those goals for you. Initially for Elena, we believe you should start a 529 plan. That's the best tax advantage college savings account. We're going to contribute $50,000 from the initial home sale as she's attending college much sooner than Mateo, and we need to make that initial contribution in order to meet our goals. We'll also contribute an additional $710 a month for the next 3 years to fully cover her tuition costs. For Mateo, we also recommend a 529 plan contributing $31,000 from the house sale on top of an excess of $640 a month for the next 7 years. In regards to your individual retirement savings accounts, you currently have a Roth IRA with a balance of $18,400 that you're not currently contributing to. We recommend a transition from the Fidelity investment grade bond that you currently are investing into a target date fund, as it's a much more aggressive fund and will yield higher returns for retirement. We also recommend a max contribution to this of $7,500 annually. In regards to your individual retirement savings, Miguel, you also have a Roth IRA opened up with a current balance of $62,000, and you're currently contributing $100 a month to that. We recommend a max contribution similar to Sophia of $7,500 annually. In terms of your 401k, you're offered a 50% employer match up to $4,000. So our recommendation is contributing $665 a month as a way to take full advantage of that employer match, as it's free money for retirement. Outside of your individual retirement savings, we also recommend that you open up a Vanguard account and start contributing $443 a month to an index fund, as it's a conservative way to invest and accrue more money for your retirement balance. As previously mentioned, you also have your high yield savings account, which is already housing the $20,000 emergency fund, plus an additional $250 a month, which again, add money to your end retirement balance.
Thank you, Ben. So we are really happy to say that with our recommendations, Rosa's living situation and any extra medical costs are completely taken care of, and your family is now ready for Elena to be driving in a couple of months. And Miguel and Sophia, you will be able to retire by the age of 65 with nearly $3 million and enough money to send both of your children to college to get an undergraduate degree debt-free. We appreciate your time, and thank you very much.
I'm just gonna take a minute and formulate our questions.
Take your time. Thank you. Great work, guys.
May I jump in? You mentioned that Rosa would have a health savings account. Can you tell me more about, how she's eligible and what the contribution limit would be for Rosa to a HSA?
I do believe that health savings account is opened under Miguel's plan, but it can be used to cover some of her medical expenses.
Ah, so the funds would be coming from Rosa's pot of money, but going under Miguel's name in the HSA.
Correct.
And is there a contribution limit
I
per
believe
calendar year?
that we were max contributing to that. Okay. There is a max, we weren't able to completely max contribute because we had to allocate some of that money to others, but we did find out, we decided that that would be sufficient to cover Rosa's medical care without the max contribution.
By putting some of Rosa's money, I think is what you were referring to, like 50,000 for Elena and 31 for Mateo into their college funds, would it be better to have that invested somewhere else and then start out their college plans and even let them use student loans? Because
We know that a goal of yours was to cover that college expense, and we think being able to set them up with this amount of money going to school debt-free is gonna be better for their future. And in regards to your guys' own future, we feel that $3 million is enough for retirement based on the expenses that we've calculated for you guys.
So you're saying there'll be about $2.9 million. How much pre-retirement income are we gonna replace?
What do you mean by that?
So if they take their income today and you're forecasting $2.9 million,
So, yeah, so that's not counting in social security, but, I think what your question is getting at is the general rule of thumb is taking out 4% per year. They're, making around 124,000. Taking out that 4% at just around 3 million will leave them annually with around 120,000, covering around 25 years. Generally, families who are retired, spend less, so that can cover a bit more time if we stretch it a bit farther.
and for retirement contributions, should we do more pre-tax or more Roth?
We believe Roth, because you're not in a currently high marginal tax bracket right now, so taking off that deduction right now, we see as not as fit as being able to take it out tax-free when you're retired.
And is the money tied up? If we use the Roth, are we able to access it in 3 years or 5 years or 10 years, or have to wait till retirement?
You can start withdrawing from most retirement accounts at around 59 and a half, so.
But there are tax penalties if you do need to withdraw earlier.
In the Roth IRA?
Yeah.
is the disability insurance have that much value? Like, how much do we put in versus what could it cover?
For Sophia, we found a plan for $43 per month, which would get her $1,000 a month. It didn't, we weren't sure how much Miguel's coverage was, but it did mention that it had short and long-term disability, which we saw as being valuable considering that the majority of people will need this at some point, and most people are not enrolled in it.
Would you mind going back to the life insurance slide for me?
Yes.
Great. I'm good.
Great job.
Diane, you're good?
Thank you.
Thank you.
Thank you.